As they say, the greater the risk, the greater the reward, which is why treasury bonds will pay you less than debt issued by a silicon startup. The odds of losing your investment with the startup is much higher, so the startup offers more to allure your investment dollars. In finance, we use Sharpe ratio to summarize that risk-reward relationship. Sharpe ratio helps investors understand the reward they're receiving for taking on additional risk when investing in anything but a risk-free investment. To calculate the Sharpe ratio of an investment, we subtract the risk-free rate from the average rate of return and divide it by the standard deviation. Here's the formula for you guys. And don't worry, it's not nearly as difficult as it looks. Numerator starts at the risk-free rate, which is the rate of return of a hypothetical investment with no risk of financial loss. And typically, this is treasury bills or treasury bonds. We proceed by subtracting the risk-free rate by the average annual rate of return. The average annual rate of return is the sum of annual returns for an investment divided by the numbers of years since its inception. In the denominator, we have the standard deviation. The standard deviation is a measurement of volatility or risk, and it's figured by averaging the distance between the highs and the lows of an investment as it encounters systematic and unsystematic risk. If you're curious about how standard deviation or systematic and unsystematic risk work, head back to our channel and look for their titles. So, if we assume a risk-free rate of 1% and an annual average rate of return of 8% and a standard deviation of 5.5, we can begin our calculation. We start with the numerator, subtracting that 1% risk-free rate from our annual average rate of return of 8%. And that provides us with 7. We then divide by the denominator, our standard deviation of 5.5, providing us a Sharpe ratio of 1.28. Anything above 1 is well worth investigating. Thank you guys for tuning in, and if you would like to learn more about retirement, click on our subscribe button.